from the perspective of enterprises, let's now move to the lens of investors. And कोशिश करते हैं जानने की कि साइंटिफिक इन्वेस्टिंग और ट्रांसपेरेंसी कैसे हैंड इन हैंड जाती है, हाउ इट गोज हैंड इन हैंड. So now I invite our next guest speaker, Dr. Vikas Gupta, the CEO and Chief Investment Strategist from OmniScience Capital. He will be talking about scientific investing, building investor trust through transparency and market practices. But before that, let me give his introduction that he is widely followed in the capital markets. Widely, his views are sought by media and all that. So he needs no introduction in a way. So I welcome him. Sir, please share your views and how data, discipline, and transparency can reshape investor confidence and market behavior. Please, over to you, sir. Thank you.
Thank you, Aryan. Pleasure to be here. And so I'll divide this into two parts. One is I'll give a brief introduction to the idea of scientific investing. And then that will help us understand that how VRIGHT is enabling the ecosystem to apply scientific investing to the smaller companies. And you will understand why it's needed once I go through this. So our whole thing, and even it might not be readable, but behind me you can see the slogan of OmniScience Capital is Science of Alpha from Safety. So when you are in equity markets, most participants are talking about returns, that how much returns they're going to generate and so on. And most of the time, the retail investor or even other investors come into the market when there has already been a significant up move in the market. So kind of somewhere near the bubble peak. And maybe for a short duration, 6 months to a couple of years, they make a lot of money, or seemingly make a lot of money. And then markets fall, they're not prepared for it. And a lot of people, especially retail, call it gambling, right? So that's the kind of the alternate view of markets in a large segment of investors. So that's why we focus that once you are in the market, most important point is to keep in focus is safety. Okay, again, and safety as in you could obviously go for SBI fixed deposits, that's safe. So we're not talking about that kind of safety. We are saying you are taking the equity risk. Now, how do you reduce your risk, or how do you increase the safety, right? So if you take care of safety and you are invested in the market, returns take care of themselves, right? I mean, Sensex was 100 in 1979, and today it is somewhere around 80,000 to 85,000. It keeps moving. And the true Sensex, I call it the true Sensex, is actually above 100,000. So what does, and I'll tell you what is the difference. The Sensex you see daily is the price return of all the stocks in Sensex 30, while the true Sensex, which I'm calling, it's the Sensex Total Return Index. So if you type in Sensex TRI in Google, you'll get that number as well. Sensex Total Return Index, inclusive of dividends, it's more than 100,000. What does that mean? That means if you had invested 1 crore in 1979 in Sensex, today you would be sitting on 1,000 crores. Okay, so that's the power of the markets. That's the power of the economy and the companies here. So money will be made if you are surviving in the market. So that's why safety first. So the whole investment philosophy of OmniScience is based on this, what we call Omni Insight, that most market participants chase alpha or returns, but what they end up with is risks in their portfolio. While one could chase safety and end up with alpha. So this is our Omni Insight. And on this, the whole scientific investing framework is based. And I'll very, very quickly run through this so that you get a reason. Then you can connect why we need things like VRIGHT exchange and better at SME exchange, etc. So our starting universe is the whole market. And typically, so things will change now, but typically we restrict our investments to companies which are worth 1,000 crores or above. And the easy way to do that is just look at the market cap 1,000 crores and above. But I said worth, intrinsic value. So sometimes the company which is worth 1,000 crores or 2,000 crores might be selling for 500 crores in the market. So that's okay. So that might be part of our portfolio. Okay. But typically we are cutting off at 1,000 crores market cap and above, because we want more transparency, more information and all that. And the kind of information we want is very, very straightforward. We divide the whole market, and this is how we are increasing safety. So there are a lot of highly leveraged, high debt companies in the market. And naturally, these are very risky. If I take and loss-making companies or consistently loss-making, consistently negative cash flow companies in the markets. And you don't want those companies. Even above 1,000 crores, there are a lot of such companies. And these we call capital destroyers. Now, that doesn't mean all of these companies are going to destroy capital. And what do we mean by capital destroyer? Means the capital, the shareholder capital, which is in the net worth of the company. We are talking of that. We're not talking of the stock price, right? So the more a company is leveraged and a crisis like COVID strikes, the chances are that the shareholders can be wiped out. Because if they cannot pay back their debt or they cannot service their debt, the lenders are going to become the owners and shareholders will go to zero. So that's capital destruction, right? So we take out the whole capital destroyers from the list of companies. There are about 1,500 companies above 1,000 crores today. So if I take out, maybe 600 odd companies might be taken out, okay, at any given point of time. Highly leveraged or loss-making or consistently negative cash flows, etc. And I'm not saying all these things are bad, but as a whole, statistically, those things are bad. Okay, so as soon as I take this group out, the remaining portfolio, let's say there are about 900 companies left or 800 companies left, that Nifty 800 or BSE, S&P 800, whatever you want to call it, that would already have some alpha, because the portion which I took out, at least 50, 60 companies would go out of business in the next 5 to 10 years, depending on how fast something. So statistically, we have taken risk out. And in the remaining companies, you could just buy and you'd have a little bit of alpha there. But we have to go to the next stage. There are a lot of companies which are profitable, paying taxes, but they're not creating shareholder value. What do I mean by that? So these we call capital eroders. What they're doing is they're using shareholder capital, but the return on that shareholder capital is very close to what you would get in a fixed deposit. So single digit return on capital. And if you are earning single digit return on capital, it would have been better if you had sold off the company, taken the shareholder capital and put it into SBI bank deposits, fixed deposits, and then no hassle, no operations, and you would be making the same amount. So if you are doing that with the same amount in listed space, it's not adding any value to the shareholders. If your return on capital or return on equity is not even earning the cost of capital. So many shareholders think this is a profitable company, they're paying taxes, it's fine. No, it's not fine. You have to stay away from these eroders because they're eroding your capital over time. You won't have a sudden fall in the net worth or anything of the company. So we take out eroders, maybe 200-300 companies are gone. Now from the remaining companies, all are good to great, balance sheets are strong, their operating profits are good and everything. But some of the best companies here are well known to the market because of the media and because of the analyst community, etc. And then they start getting chased. Because they're good companies or great companies, actually people start chasing them and maybe high growth, and they become overvalued. And then they become extremely overvalued and they become very, very, very extremely overvalued. So it could be as high as 2 times the intrinsic value or even 5 times the intrinsic value. But they're good companies. So media is consistently writing about them and it attracts retail investors to it. And then it becomes like a self-fulfilling prophecy where you think, high quality, high growth companies, you can pay any price and it will be fine. And I've been talking about this for more than 10 years in the media. Multiple articles I've written about this or talked about that a great company is not a great investment. A great company is a great investment only at a great price. Okay. If you are overpaying for a great company, eventually you are in trouble. And we have seen that trouble finally. For many of these companies, last 5 years, when the total market has given a fantastic return, the 5-year return for this high quality pack is very, very insignificant. Okay, so and still they are overvalued. So we take out these capital imploders, which are good companies but overvalued. Next, we come to what we are left is what we call capital multipliers, because now you are 3 levels of alpha already. You've taken out destroyers, you've taken out eroders, and you've taken out imploders. So all the ways of losing money we have taken out. Now, I'm not saying everything is there, but all the top ways you could lose money on a fundamental risk basis. I'm assuming that the company was not listed at all. You would still go through these risk factors and reduce them for yourself. Now we look at, okay, now that we have enhanced the safety of the remaining portfolio with 3 levels of potential alpha and significantly reduced risk, so high, low risk and high return possibly, potentially. Now we look at what we can do to enhance the returns further. And this is where now we start looking at each and every company by company. Till now, you could do it in a quant way. Okay. But now, let's say there are about 80 to 150 companies left, depending on whether you are in a bull market or bear market. And you have to go through each company to find out whether they have growth. Okay. Whether they are exposed to what we call growth vectors. So, for example, in India, India is one of the highest growth major economy in the world, and it will remain so for next 20, 30 years. So many of the new sectors are going to become what we call growth vector. So the idea of growth vector is something which is driven by the economic environment, where there is a pull factor from the demand side from the economy, and the companies ride on that. Okay, it's not that company makes a lot of investment and it will grow. It should be that there is an external demand which is pulling and which is going to last for more than 10 years. So that is what we call growth vectors. And in India, there are numerous growth vectors, right? And for example, I mean, we had identified defense as a growth vector in 2020. Okay, we had identified railways as a growth vector, and we had portfolios around that. We had launched a digital transformation growth vector earlier around 2017-18. So you can identify a lot of these things if you pay attention. Now, this is where the quant doesn't work anymore. You want all the high growth companies which have historical high growth, but you also want to see what is the forecasted. What is the likelihood of getting high growth and sustaining it? And for that, we do the growth vector analysis, for which we need information on the company's plans. And then we want to see whether you have the resources or your business model, the capital generation model of yours provides enough capital for you. So there is capital on the balance sheet, and there is capital which will be created in the next 2 to 3 years because of your return on capital, right? Internal accruals, what we call. Is that sufficient to finance your growth? I want to grow and I just borrow and grow. That is not sustainable. So you need companies which have this self-sustaining cycle where their own capital, their own cash flows allow them to grow at a high rate. And the external part is that they should be exposed to the growth vector. So this kind of information becomes qualitative. There is quantitative part in it and there is qualitative. That is the management visionary enough? Are they seeing that growth vector as well? Just like we are seeing this is a growth vector. Are they able to capitalize? Do they have the competence compared to the other participants in the economy, competitor companies? Are they better placed? Do they have resources? Do they have a vision and strategy? Is it a convincing strategy? Because as soon as let's say electric vehicles becomes a theme or a growth vector, all the companies start claiming, oh, we are also doing something in the EV ecosystem or EV value chain, right? So it's not that claims. You need the genuine capabilities. And this is the kind of analysis we need to do. And we need to know what is the future. Nobody knows. But on what basis are you saying that I'm trying to capture a bigger portion of this high growth market, etc.? So that is where now we'll connect it to VRIGHT exchange. So as I mentioned that we typically look at companies 1,000 crores and above. Now it's not that we don't believe there are very good companies below 1,000 crores. Okay, so let me now switch to the VRIGHT thing. so far we have launched investment strategies above 1,000 crores. But now I can see if something like VRIGHT is available, that I can consider something in between venture capital or private equity, which is completely unlisted mostly, and our current strategy, which is mostly on the large listed companies, small caps, but larger listed companies. This in between portion, the SME and slightly larger, which move to the main board, those companies, as the transparency increases, if we get regular, first of all, that what are their plans? Typically, companies have an investor day. If the SMEs start, conducting an investor day once in a couple of years, also every year would be great, but even once in 2-3 years, and give the vision for the next 3 to 5 years and precise information, very detailed information from the CEO, CFO, head of product, head of marketing, so that we get the clarity that actually how authentic is your so-called plan to triple my revenues in 3 years, right? So all these kind of statements then can be backed by authentic information, and people, investors or analysts, can cross-question the appropriate heads and get a feel whether you have actually thought about this in detail or not. Now, it's not that your plan will completely work out as mentioned. It won't. But if you give this plan and in every quarterly or annual update, you are transparently sharing what are the challenges and what are the wins, then that kind of a place is where people like us with very hardcore, fundamental oriented, very safety oriented, where investor money protection is the game, will be feeling comfortable in investing in the smaller companies. And our view still is that typically the smaller companies are not transparent. And it might be just now, Mr. Patel talked about it. So it might be because they don't have a platform or they don't know. Now there is a platform where we think we can get all the earnings call transcripts. We might be able to have live interaction with the management during the earnings calls. We might be able to get their plans even sometime in between, right, on a scheduled call, and get more information. So that's why we are excited about VRIGHT Exchange. And Aryan, over to you.
Yes, sir. Thank you so much, Mr. Vikas. Dr. Vikas, sorry, for your fantastic articulation of how scientific investing works. And thank you so much. And I'm sure that OmniScience Capital over the years, it commences a journey in 2016, and now within this time frame, the company has a portfolio of over 1,200 crore. So that's commendable. Thank you so much to the entire team.